From the opinion pages of the Wall Street Journal, this is Potomac Watch.
Welcome back. I'm Paul Gigot with Joe Sternberg and Kim Strassel. And let's move on to the economy, which we have a couple of big data points this week. One on Wednesday, where the Federal Reserve raised interest rates again for the fourth time by 75 basis points. Now the target rate for Fed funds is 3.75% to 4%, coming off of zero not too long ago. When the investors first saw the Federal Open Market Committee statement, they were elated because they interpreted some of the language, which was new, about the Fed taking into consideration lags in the impact in timing of interest rate increases, perceived that to be dovish, and stocks popped and bonds popped up. And then Jay Powell gave his press conference, as he always does, after the FOMC meeting, and they didn't like what they heard, which was Powell said no flagging in the Fed's determination to get inflation under control. Riskier not to do it now and quicker than to do it more slowly. And the terminal rate, that is the end top rate that they may have to go on interest rates, may be higher than he had even said into September, which suggested that it might have to go higher than 5%. And that's where the markets now have priced in their expectations. Joe, number one, did Powell do the right thing in taking a hawkish position? And why don't the markets like it?
Well, I think that he did do the right thing by reasserting, especially in his press conference, that he is still focused like a laser on the inflation issue. Because, I mean, in a lot of regards, the Fed has actually had a surprisingly easy time so far in this tightening cycle because, the labor market has not collapsed. Unemployment is still surprisingly low. In fact, listening to Chairman Powell's press conference, he seems a little surprised that the economy still is as healthy as it is given the interest rates currently are. And so what he's trying to do, I think, is use as much of the running room as those economic outcomes give him to increase interest rates to try to bring the inflation under control. He will be aware that this would be a very different conversation if unemployment already had started to creep up in a noticeable way. He would be under a lot more pressure to slow down. But I think that the problem is, markets are discovering that they do not enjoy this process of having to learn how to invest again in an environment where interest rates aren't rock bottom. And we're seeing all of these stories about a rotation out of investments in tech companies that have a mixed history of profitability or delivering dividends, and back into companies that have a history of paying higher dividends, perhaps being a bit more productive and profitable. And that process is very unpleasant for the people on Wall Street who are going through it. So you can understand why they're unhappy about this. I think that the big message from the Fed on Wednesday was, we're maybe kind of sympathetic to that. Maybe we won't keep raising rates at the same pace that we have been up to now, but we're also not super sympathetic to that complaint because we are going to continue the increases and we might even end up at a higher level than you thought that we would.
Yeah, Joe, I agree with you. And I think that Powell is surprising me a bit on his hawkishness here. Maybe I shouldn't be surprised, but for so long he was on team transitory, which is inflation is transitory, don't worry. And we've got all the tools. We'll just get under control easy, don't worry. And then inflation started sprinting upward. And he seems to have understood that the Fed has played a role here and that he has to do something about it. And the Fed is proceeding to do so. And it's particularly interesting this time because early in the interest rate raising cycle that we're now in, there was a little political opposition. Now it's growing, and it's growing particularly on Wall Street, where people are very concerned, as Joe described, Kim, about the markets, equities in particular, way down. And then they're also saying, well, wait a minute, we could get a financial crisis here, which they are correct in saying we always seem to get of one kind or another, sometimes serious, sometimes just smaller incidents, when we have an interest rate cycle that goes up. So that is a risk the Fed has to pay attention to. But you're hearing that a lot on Wall Street now. I had one Wall Street economist call me last week and say, something could break. Powell may break things. We got to be careful. And then, of course, politically in Washington, you're seeing the Democratic Party members start to worry about the impact of raising rates. Sherrod Brown, who's in charge of the banking committee in the Senate, sent a letter warning Powell of those effects. Elizabeth Warren has been out there with others. So, Kim, the window politically for the Fed to keep raising rates is probably, it's not closed, but it's getting more difficult for them to raise rates.
Well, this is why I was pleasantly surprised by Powell, not just because he was being so firm on this, but because he's being firm now at all times. He hasn't always been that resolute, and that's been part of the problem. If you go back and you look through his history, he's been, in my mind, a little bit too easily swayed by political criticism. Remember when, not long after he was nominated for that position, Donald Trump started beating up on the Fed over the possibility of interest rate hikes. Powell backed off of that. Democrats, as he was leading up to his renomination in November of 2021, were really beating on him as well, saying you just basically need to keep monetizing all of our spending and debt. And he actually even got on board and publicly called for more fiscal stimulus, the exact opposite of what we should have been doing at the time. All the signs suggested that we were headed toward higher inflation. The economy was hot, unemployment was dropping. So in the past, he hasn't been this way. Now, here we are, and this is a moment where it's really going to get tough, and you're seeing that. All kinds of wailing and gnashing of teeth. Warren has been particularly bad. And you've got a whole campaign of Democrats who are trying to make this crazy argument that actually the way we need to get ourselves out of this mess is to spend more on all of their entitlement agenda. And so far, he's rejecting all that. Now, I agree. I think it's going to only get harder. But one of the things the Fed has done smartly here is raise quite aggressively in 1 month after another. And that means that it's now, closer to 3.75, 4%, closer to that terminal rate you're talking about. That may give them the opportunity to finish doing the hardest pill administering, and then maybe, as FOMC suggested, tail back just a little bit.
Joe, I'll give you the last word here, but just a couple of factual points in the substance. The personal consumption expenditure inflation, that's the rate that the Fed cares most about, was still 6.2% over the last year from September to September. That's 3 times the Fed inflation target of 2%. So inflation is by no means anywhere under control. So the Fed has to do something. Now, there are people who say, oh, well, look, the money supply is shrinking. It's been the growth that we saw during the pandemic has really closed down. And now it's rising so slowly, the money supply, that we could see something crack in the financial system. Look, having lived through the financial panic of 2008, I don't want to repeat it. So I think you have to be worried about that. But on the other hand, with unemployment at 3.5% and so far the financial system holding up pretty well and the banks seeming to be well capitalized, I think now's the time to raise it. But what do you think?
Well, I mean, it is worth pointing out that we've already had one of the first big cracks appear in the financial system in the UK, where remember we had that episode about 6 weeks ago where there was a fiscal policy announcement from the government of then Prime Minister Liz Truss. It set off a bunch of interactions in the bond market that I think we still don't completely understand that had to do with vulnerabilities in the pension system. And no one over here had expected that pensions could be vulnerable to rising interest rates until the moment that we discovered that they were very vulnerable. And I suspect that that example, even though it didn't lead to a full-blown financial crisis in the UK, is probably giving a lot of central bankers around the world, including Jay Powell, pause as we continue to get into this tightening cycle because they've realized that you really aren't going to know where the danger is. But the problem is that that's not going to be an excuse to not continue tackling inflation. And one thing that I think the Fed does seem to be discovering, although he only mentioned it very briefly at the end of his press conference yesterday, they do seem to be realizing that maybe they don't fully understand exactly what's going on in the economy and what's going on with the inflation right now, because he did express some surprise that their policies have not worked as much as their models might have predicted by this point in the tightening cycle. And I think that that is really significant because it's going to illustrate their dilemma where they might find that they are sort of veering off what they thought was the beaten track here and are really going to have to be mindful of some of the risks that are developing, even as they've become very mindful of the risk of allowing inflation to continue running out of control.
All right, we will get another indication of the underlying strength of the economy when the jobs report for October comes out on Friday of this week. We'll be watching closely for that. Thanks, Joe. Thanks, Kim. Thank you all for listening. And we will be back tomorrow with another edition of Potomac Watch.